Guys, I can't tell you all how pumped and excited and stoked I am at the same time for today's session. But before we start today's class, I want to tell you all something. The first few topics are going to be pretty boring and slow, and the reason why I say this is because I want to start from level 0. I want the foundation and the base of this course to be strong and proper. There might be a few people here who don't even know what stock market is, so I'm doing this for those people. There are chances that you might already know all these things, and if at all you are a pro and you know all these basics, just bear with me, guys. There is nothing for you to lose here. It'll just be like a revision for you all. So now that the disclaimer is done, I would like to introduce you all to the 7-day stock market bootcamp, day 2, which is called pre-game. So without wasting any further time, let's straight away dive into it. The first question we have is, what is stock market? Well, the answer to this question is right there in these two words, stock market. A market where you can buy and sell shares is simply called as stock market, right? So what are stocks? Stocks are a small fragment or a small portion of a company. So if at all I am telling you that I own 10,000 shares of XYZ company. So what I'm basically trying to say is that I own a small portion of the XYZ company. It is as simple as that. So 2 points here. What is stock market? A market for stocks. Think of it as any market that you can think of. Supermarket, groceries market, any market. So point 1, market of stocks is called a stock market. Point number 2, stock is basically a small portion or a small fragment of a company which you can buy. So now you might be asking me, how do companies make themselves available in the stock market? Like, how do they bring their stocks to the market so that the people can buy them? Well, to understand that, you need to know what IPO is. IPO basically means initial public offering. So the process of a company making its shares available for the public to trade or to invest or to buy for the very first time is called as initial public offering. It is very simple, guys. So now, what does the company do after it decides that it wants its shares to be publicly traded? It does not straight away come to the public and tell the public to buy their shares, right? So there is a procedure, and that procedure is called as IPO. So guys, what happens here is that once a company decides to go public, once the company decides that yes, now we want our shares to be available for the public to trade, what the company does is that the company enlists or enrolls itself under an exchange, and then the exchange makes it available for the public to trade, invest in that company's shares, in that particular company's shares, right? So it's very simple. Now let's talk about what exchanges are. Exchanges basically are a body or a facility where all the transaction, all the buying and selling of shares are taken care of. Every possible thing that you can see around yourself which are being traded, right? All those financial segments and all those financial products are all listed under an exchange. So there are 2 exchanges in our country, NSE and BSE. NSE stands for National Stock Exchange. BSE stands for Bombay Stock Exchange. If at all you're wondering what are the differences between these two, do not worry about it. Just chill out. NSE, BSE, just the same thing, just 2 different names, right? Now I want to talk about a great misconception that 95% of the people have. What people tend to think is that once you have invested your money into a company, once you have purchased a few shares of a particular company, people tend to think that the money which you utilized to buy those shares directly goes to the company, and the company utilizes that money as their capital to further conduct their business. This is not true. The money that you use to buy the shares of a particular company does not even go to the company. It never happens. So where does the money go? To understand this, you need to know what primary and secondary markets are. So let's get right into it. So in the procedure of the IPO, what happened was that the corporations or the companies or the firms, whoever wants to go IPO, went to the exchange, right? And the exchange made it available for the public to trade or to invest in those shares. But there is one part that is missing there in between. The first ever time when the shares are purchased, right? So if a company went public today and someone bought, say, 5 lakh shares of that company tomorrow, those people are not the normal people like you and me. They are not the normal public, right? Those people are promoters. Those people are hedge fund managers. Those people are portfolio managers. These people are the ones who have a lot of money with them, like humongous amount of money, in thousands and thousands of crores. So those people are the ones who get to purchase the shares of a company for the first time, right? So that particular market where those people buy and sell shares is called as primary market, guys. Please understand this. This is really important. So when the shares are purchased for the very first time, that is called as primary market. All right. And then, so the transaction between the primary market contestants and the company is done. So after these people have purchased the shares of the company, the primary market contestants, what do they do after that? They're not going to keep those shares with themselves all their lives, right? They have to sell it further to someone to make their profits. So that is when they sell their shares into the secondary markets. Guys, this is not primary market, right? That's a mistake. I'm so sorry for that. It's secondary markets. So what is secondary markets? Secondary market is basically a place where people like you and me, the normal people, trade. So these people come into the secondary market and then they sell their shares to us. And then we people keep exchanging the shares among us. So if at all I am buying, say, 10 shares of XYZ company, for me to buy 10 shares of XYZ company, there has to be someone who's willing to sell 10 shares of XYZ to me. So I am buying those shares from a market participant. The company is not giving it to me. The exchange is not giving it to me, right? I am taking it from somebody who already owns it. So how did the money go to the company? It does not ever go to the company. So this is the reason why stock market is called as a zero-sum business. The money is never ever generated in stock market. There is a lot of money in the markets. It's just that the pockets keep exchanging. Let me explain it to you with an example. So this person right here, Aman Hamdani, which is me, wants to buy 10 shares of Reliance company. So what do? I go to a broker and I tell the broker, dude, I need 10 shares of Reliance. So what the broker does is that the broker allocates and facilitates the trade for me. The broker searches for someone who is willing to or who wants to sell 10 shares of Reliance at 10 rupees, right? Once the broker finds this person, the transaction between me, the buyer, and the seller is completed. So what did you understand here? I am a buyer and there is a seller on the other side, right? So I want to buy, somebody else wants to sell, transaction completed. What if I wanted to buy and there was no one on the other side who was willing to sell? The transaction would not be completed. It is the same way other round also. If you want to sell, there has to be a buyer. As simple as that, zero-sum business. I hope you're able to understand this. So let's understand what brokers exactly do. You cannot directly go to a company to buy shares. You cannot directly approach a company and tell that, I want these many shares of your company. You can't do that. You can't even go to the exchange and take the shares, because the exchange only deals with the members or the companies that are listed under them. So you need to have a broker. If I want to purchase 10 shares of XYZ company, the broker's work is to search someone who is willing to sell 10 shares of XYZ. And in return, the broker keeps a small amount of brokerage or fees or whatever you want to call it. So there are hundreds and hundreds of brokers in our country, Angel Broking, SBI Cap. So once you open an account with the broker, you will have something called as a demat account. Well, demat account, basically the full form of demat account is basically dematerialized, right? So once you have a demat account, you can buy, sell, and you can do all those sort of things with the demat account. A demat account, you can say, is just like a savings bank account, but from this account you can buy and sell shares. It is as simple as that. Opening a brokerage account is pretty simple. You can just Google it out. You just need a few documents to do it, and then you're just good to go. So now let's talk about the different market participants and the differences between them, right? So majorly there are just two different types of market participants. One is retail traders and one more is institutional traders. Under retail traders, there are four different kinds: investors, swing traders, day traders, and scalpers. Who are investors? So now let's say I have purchased a few shares of XYZ company and I want to hold those shares for the next 2 years or 3 years or anywhere above 1 year. I become an investor. So basically I purchase the shares and I hold on to them. All right, so I'll be called an investor if I do that. And then there are people who are called as swing traders, people who buy today and sell after 2-3 days, right? People who do not want to stay in a trade for more than 2-3 or maximum 6 days. And then there are day traders who are pretty famous. I am sure most of you watching this want to be day traders. Day traders are basically the people who do not continue any positions no matter what for the next day. Profit, loss, whatever it is, they close all their positions the same day and then they come back the next day. Then there are scalpers. Scalpers are the ones who do not like staying in a trade for more than 2, 3, 4, maximum 5 minutes or say 15 minutes. So you get the idea here, right? So scalpers are the ones who stay in a trade for minutes, That's it. So now let's talk about institutional traders. Who are institutional traders? Institutional traders are basically the ones who have a lot of money with them, humongous amount of money, say 500 crores, 1000 crores, 1500 crores. So who are these people? These are not normal people like you and me. These are promoters. These are hedge fund managers. These are portfolio managers, people who have a lot of money with them. So there are two different kinds of institutional traders, FIIs and DIIs. FII is anybody or any money that is coming from outside India. And DIIs are basically called as Dalal Institute of Investors. FIIs are called as Financial Institute of Investors. DIIs are the same as FIIs, but these people are within our country. So that is all the difference between FII and DIIs. So who are these FIIs and DIIs? The investors like hedge fund managers, mutual fund managers, portfolio managers, promoters, all these people who have a lot of money with them, who have a lot of buying power, these people are basically called as institutional traders. They are FIIs and DIIs. We have already spoken about that. So now let's talk about the different major markets that are there. There are three major markets: Forex, commodities, and equity. So what is Forex? The trading of the currency pairs that happens is called as Forex. So what are currency pairs? Everybody knows that the value of a currency always keeps fluctuating. Yesterday, the value of Indian national rupee versus American dollars was 72 rupees. Today, it might be 73 rupees. Tomorrow, it might be 74 rupees. So these fluctuations that keep happening are monitored and traded actively. And Forex is one of the biggest and the most liquid markets when you compare it to the other markets. So let's talk a little more about currency pairs. So if I am saying INR/USD is equivalent to 72 rupees, what does this mean? This basically means that the value of INR when you compare it to USD is this much. So INR/USD equivalent to 72 rupees. In other words, if I take 72 rupees from India and go to America, I will be getting $1 in exchange. So 72 Indian national rupees is equivalent to $1 in America. It is as simple as that. The same way there are many other Forex pairs. There is GBP and USD. GBP is Great British Pound versus USD. So that will have its own value. And then there is Canadian dollars versus American dollars. So that will have its own value. And all these values keep fluctuating in real time. So now let's go on to the next major markets that are there, which is called as commodities. Commodities are basically the tangible items and things that we people use in our day-to-day life. For example, petrol, cotton, aluminium, gas, all these things we use in our day-to-day life, and even the prices of these things actively change. So even these prices are actively traded and monitored. So commodities are basically categorized into two different parts: metals and energy. Under metals you have silver, platinum, copper, palladium, gold. Under energy you have crude oil, gasoline, heating oil, and all those things. So you get the point here, right? Anything that you can see, anything that is physical, anything that is a material and is being traded on the stock market, it is under commodities. And then the third kind, the equity markets. Equity markets are basically a marketplace where the individual companies bring in their shares, right? So there are a few examples here. Titan, which is one of the famous companies in India. Titan, and then there is Tata Steel, and then there is SBIN. SBIN is the State Bank of India. Reliance is also one of the most famous companies in India. So these companies have shares, and these shares are traded under an exchange in the equity markets. It is as simple as that. So by now you already know that a trader's job is to buy low and sell high. Buy something at a lower price, wait for it to go higher, wait for the prices to go higher, and sell it and make profits. So now let's think that you want to make your first ever trade. You want to buy into a company because you have done your analysis and you feel that the shares of that particular company are going to go higher. So how many different ways do you have of doing it? How many different ways do you have of investing into that company? Let's talk about that. For you to understand that, you need to understand the entire structure of the markets, which we have already gone through. There are the main markets, and then under the main markets, there are commodity markets, equity markets, and then there are Forex markets, right? So now let's say that you want to trade in equity, right? You want to purchase a few shares of Reliance, for example. So under equity, you have different financial products or different financial segments. Number one is cash, futures, and options, right? So what are the differences between cash, futures, options, call, put, and what are derivatives? Let's get into it without wasting any time. So the first thing that we're going to do here is try to understand what derivatives are. Think of cash segment as an apple, and futures segment as apple juice, and option segment as apple smoothie. So can I say that apple smoothie and apple juice are derivatives of apple? I can absolutely say that. And if at all you want the definition of the derivative, it is right here, you can read it. A derivative is a financial security with a value that is reliant upon or derived from an underlying asset or groups of assets. Do not understand the thing? Not a problem. So now when I say that future segment is apple juice and option segment is apple smoothie, what I'm basically trying to say is that apple smoothie and apple juice both have come from the apple. Both of them derive their value from the apple itself. If the apple is sweet, apple juice and smoothie are going to be extremely sweet. If the apple is not sweet enough, the juice and the smoothie will not be sweet enough. That is all you need to understand. So future segment and option segment both derive its value from the cash segment. All right. It is as simple as that. There is nothing for you to get confused. Now let's try to differentiate cash segment from the future segment. In cash segment, you have no restrictions of how many shares or how many minimum shares you have to buy. You can even purchase a single share, right? You become a shareholder. After you purchase a few shares under the cash segment, you become a shareholder. In other words, you have the ownership of that company. You receive dividends, bonuses, etc. If you do not know what dividends are, think of dividends as rent. Let's think you purchase 1,000 shares of a XYZ company. So that XYZ company keeps giving you a yearly incentive or a yearly dividend or a yearly bonus because you are invested in their company, right? So you can keep these shares for a lifetime. There are no restrictions on that. You can keep these shares for how many ever long you want. It is extremely suitable for long-term investors. You need to pay the full amount in cash. What does this mean? If the price of a share is at 5 rupees and you want to purchase 5 shares under the cash segment, you need to have 5 into 5, 25 rupees altogether upfront to purchase 5 shares of that particular company, right? So you need to have the entire amount with you. So now let's talk about the future segment. You have to trade according to the lot size. You cannot purchase 1, 2 or 3 shares. You have to purchase shares according to the lot size. So now that lot might consist of 100 shares or 200 shares or 1000 or 2000, how many ever shares. So the minimum amount of shares you can buy is 1 lot, and that 1 lot will consist several shares, right? So you cannot be a shareholder under the future segment. You don't receive any bonuses or dividends. It's just exactly the opposite of cash segment. Futures contract do not last forever. They have an expiration date. In cash segment, you purchase even 1 share today, you can keep it until the day you die, right? In futures, that's not the case. You purchase something, it has an expiration date. It fluctuates from somewhere around 1 month to 3 months. It depends on the contract that you have purchased. It is extremely suitable for day traders. It is extremely suitable for traders as the leverage is high. There is no leverage in cash segment. There is something called as leverage in futures. What is leverage? We're going to be talking about leverage in the upcoming slides, so please do not worry about it. Now you might be thinking, where is the option segment here? There is cash segment, there is future segment. Why is there no option segment here? Well, in a nutshell, options is a world within the world of stock market itself. It is a vast subject. So we're going to be talking about options in detail later on in the upcoming sessions. I have pulled out a screenshot here. As you can see right here, Bank Nifty July future. What this means is that the name of the contract is called as Bank Nifty. July is the month and FUT means future. So this contract expires on 2020 July 30th. It is as simple as that. So if at all you have purchased the shares in this particular contract, this contract will expire on 2020 July 30th. So if at all you have purchased it and you haven't closed your position, your broker will automatically close those positions, right? It will be liquefied. Just please ignore that noise. It's just the puppies on the road. Now let's talk about what is leverage. Leverage is simply your broker telling you that even if you have 100 rupees in your account, not a problem. I will give you 2 times leverage, which means you have 100 rupees. 100 into 2 is 200 rupees. You can either buy or sell shares worth 200 rupees. It is as simple as that. There is nothing complicated in it. Your broker letting you take positions worth much more than the money that you have in your demat account is simply called as leverage. So the amount of leverage given to you differs broker to broker. Some brokers have 2 times leverage, 3 times leverage, 4 times leverage. So that's how leverage works. And if at all you want to know more about it, you can just go on and read whatever is there on the screen. So now let's talk about indices. What are indices? Indices are basically a group of stocks or a group of assets all put together. So now let's talk about one of the most famous indices in our country, Nifty 50. So what is Nifty 50? Nifty 50 is basically the composition or a combination of top 50 stocks of our country, top 50 companies of our country. Any company that you can think of, any company that is huge, like say example, Reliance or Tata or Kotak Mahindra, all these top companies of our country, of India, are all listed under Nifty 50. So what is Nifty 50? Nifty 50 is basically the composition of top 50 performing stocks of our country. That is it. So Nifty 50 is basically the index of NSE, National Stock Exchange. The same way, even BSE has their own index, which is called as Sensex. So Sensex is the composition of top 30 performing companies, and Nifty 50 is the composition of top 50 performing companies. That is all you need to understand. So here you can see the composition of Nifty 50. There is Axis Bank, there is Bajaj Finance, there is ICICI Bank, IndusInd Bank, Cipla. Cipla is a pharma company, and HCL Tech is an IT company. So it's a combination of different stocks irrespective of their sectors. So any company that is good, it's under Nifty 50. So now, if Nifty 50 has to perform well, say Nifty 50 has to go exponentially higher, the criteria for that is very simple, that the majority of the stocks, majority of the companies listed under Nifty 50 have to do well, right? So it can't be that, out of 50 stocks, 30 are doing very bad and just 20 are doing average and the Nifty is going to go higher. No, that's not going to happen, because Nifty 50 is a composition of all the 50 stocks under Nifty 50. So what we observe here is that Axis Bank, Bajaj Finance, ICICI Bank, IndusInd Bank, Kotak Bank and SBI, all these are banks. So most of the heavyweights under Nifty 50 all come from banks, right? It all comes from the banking sector. So what we can make out here is that for Nifty 50 to do well, banking sector has to do well. Or if banking sector is not doing well and yet Nifty 50 is doing well, what that means is that there are a few stocks under Nifty 50 which are doing exponentially well, which is nullifying the effects of banks not doing well. What you need to understand here is that for Nifty 50 to do well, the banks have to do well, because you see there are so many banks here and the banks are the heavyweights in Nifty 50. Right. So now let's talk about what sectors are. There are various sectors. There is bank sectors. There are IT sector. There is energy sector. There is metal sector. So different sectors are named according to their sectors. So Nifty Bank will have all the banks under it. Nifty IT will have different IT companies under it. Same way energy, metals, Nifty Metals will have different metal companies under them. So this is what a sector does. It simply categorizes the companies or the stocks based on their sector, based on the nature of their business. It's as simple as that. Now let's talk about intermarket analysis. What is intermarket analysis? So now let's say you are interested in a particular stock. Let's say Axis Bank, right? So what sector does the stock belong to? It belongs to Bank Nifty. Simple, right? It's very simple. So now stock is done, the sector is done, and then after that we are going to see what the peers are doing. So who are the peers of Axis Bank? HDFC Bank, ICICI Bank, Kotak Mahindra, all these will be the peers of Axis Bank. And then in the end, you see where the broad markets are going. Broad markets in the sense, the overall markets, which includes all the sectors, all the companies. So this is how you do your intermarket analysis. You first pick up the stock and then you see what the sector is doing, and then you see what the broad markets are doing, and then you see what the peers are doing. So this is intermarket analysis, guys. It's pretty simple. You just need to have a step-by-step procedure of filtering out the stocks. So now let's talk about international market analysis. What international factors affect our stock market? Let's talk about them one by one. Number one is the USD rates, the INR versus USD. So how does the INR and USD fluctuation affect our markets? If we have to pay a higher amount to import something into our country, it is obviously bad for us because we are paying more money, right? So it is advantageous for us for the USD rates to be low. So the dollar comparison to our markets would be inversely proportional. As you can see it right here in the example, the USD prices have started hiking from this point onwards, right here. From here on, it has gone higher until this point, but our markets have reacted to it negatively. The USD prices have gone higher, but our markets have fallen down. The USD is going higher, but the Nifty 50 is falling. What does this tell us? This tells us if the prices of USD is increasing, it is really very bad for our economy. It's really bad for our stock market. It's not good. And what is the reason for that? Well, the reason for that is pretty simple. Most of the things in our country are imported, right? We import petroleum, we import so many things. If the price of dollar is higher, it is quite obvious that our government has to pay a higher amount to get the transaction done. So this is the reason why USD prices and our market are inversely proportional. Let me tell it to you once more. If the USD prices are going higher, it's very bad for our market, so our markets fall. And if the USD prices are falling, it is good for our economy, it's good for our stock market, so our stock markets rise. As simple as that. So all you need to understand here is USD prices and our markets inversely proportional. Now let's talk about crude oil. What is crude oil? Crude oil simply is the petrol, the diesel, the kerosene. This falls under commodities, guys. I hope you remember. So even crude oil is inversely proportional to our stock market. As you can see here in this example, prices of crude oil have fallen from this point onwards, right? So as the crude oil prices have fallen, our economies have taken a nice pump. It has gone higher. So this again is inversely proportional. And why is it inversely proportional? It is common sense again. If the prices of crude oil is less, our country, our government has to pay less money to import the crude oil, to import the petrol, kerosene, diesel, whatever it is. Now let's talk about SGX Nifty. What is SGX Nifty? SGX Nifty is simply the Nifty 50 index, but this is not in our country. This is not the Indian Nifty 50. This is the Singapore Nifty 50. Again, this is common sense. Nifty 50, the Indian Nifty 50 and the Singapore's Nifty 50 is exactly the same. You can see it right here. There's literally no difference between the charts. It's halting here and then the markets fell down. The same thing, it was consolidating here and then the markets fell. It is the same. So if the SGX Nifty does well, our markets also have to do well. As simple as that. Dow Jones. Dow Jones is one of the major indices of American stock markets. Just like how we have Nifty 50 and Sensex in India, the same way there is Dow Jones in America. Right? American markets are the leading markets. Wherever the American markets go, the entire world has to follow them. So whenever the Dow Jones falls, our markets have to take a dump irrespective of the domestic news. The domestic news might be amazing, like, you know, the earnings of the company might be very nice. But if the Dow Jones falls, there are high chances that our markets will fall. So Dow Jones and our markets are directly proportional. If Dow Jones does well, our markets do well. If Dow Jones falls, our markets fall. And the same way there are Asian indices, just like how we just spoke about the American index, the same way there are Asian indices also, which are also directly proportional to our markets. If the Asian indices do well, our markets will do well. If Asian indices don't do well, our markets will not do well. Now let's talk about the different analysis that people do before taking a trade. There is something called as fundamental analysis, in which people read the annual reports of the company. Fundamental analysis is you trying to understand what the company is doing, what the company is buying, what the company is selling, how do they manufacture it, where do they purchase their raw materials from, and what is the credit, what is the total debit, how much money is coming in, how much money is going out. So basically studying all these things, studying the nature of a business and then investing into it will be called fundamental analysis. And this is something that the investors do. Investors like Warren Buffett, like Rakesh Jhunjhunwala, those people are the ones who do fundamental analysis. But we are not here to learn fundamental analysis. We are here to learn technical analysis. We are interested in making money today or tomorrow or day after. We do not want to stick to a stock for the next 2 years or 3 years. So under technical analysis, you have reading charts via candlesticks, Renko charts, Kagi, and then you read support, resistance, and trend lines. You read candlestick information, whatever the patterns are, and then you try to analyze the volume, and then you use indicators, and then there is price action and all these things. So basically trying to understand what the prices of a stock might do tomorrow or day after or in the future, reading the past. This is technical analysis in nutshell. So think about this, guys. What do astrologers do? Astrologers basically read your past. They have a sample set, right? And based on that, they try to tell you your future. Though astrology is bullshit, I do not believe in it. I'm just trying to give you an example. It's the same thing what we do in technical analysis. We read the past. We see that, yeah, all right, when this and this happens, this has happened 10 out of 20 times, or say 8 out of 20 times. So the probabilities of this thing happening the next time are high. So the next time I see a pattern like this, the next time I see a setup like this, the next time I see something similar to this, I am going to take this trade. So doing all this with the help of the things that are written on the screen right now is called as technical analysis. So that's it for today, guys. That's it for day one. It was too much fun. I hope you enjoyed. I'll be seeing you tomorrow. We're going to start with technical analysis. That's where the fun begins. All the boring stuff is done. And from tomorrow, the interesting things start. So guys, if at all you have any questions, any doubts, any queries, feel free to text me, feel free to hit me up. Also, you can just type in your questions via Slido and you can send it to me. I will definitely answer those questions in the live. So that's it for today, guys. I'm going to sign off. See you tomorrow.